Ladies and gentlemen, welcome to another episode of Boss Economics World, where we break down what governments and central banks are really up to, and how they are driving economies down a dark and dangerous path. Hold on tight today because Japan's bond market is giving us the same goosebumps as the Lehman Brothers crash did in 2008. Yes, you heard it right. Japan's economic gut punch might just be the latest indicator that an epic financial storm is brewing, and not just for them, but for markets everywhere. So, guys, let's look at the scandalous state of Japan's so-called monetary policy, led by none other than Bank of Japan Governor Kazuo Ueda. Late last month, Ueda, in a Nikkei interview, hinted that a rate hike could come as early as December. And yet, what does this mean? The market reaction tells us everything we need to know about how uneasy traders feel about Japan's sudden, sluggish moves. Bond yields jumped immediately. The 2-year Japanese government bond, JGB, yield skyrocketed to its highest point since 2008. That's 15 years ago, back when the world was still reeling from the massive financial crisis. The 10-year yield jumped 2.5 basis points, read it clearly, sitting comfortably at 1.075%. Parallel to that, the 30-year bond yield hit its highest level since 2010. Okay Japan, hold your applause. Sure, these numbers look like they're just data points, but here's the absolute kicker, this is only scratching the surface. Just because the Bank of Japan slightly turns the dial on interest rates doesn't mean they're fixing anything. No, my friends, the problems run much deeper. For months, traders and policymakers had been anticipating some sort of change in Japan. The nation has been spinning in an economic whirlpool of stagnant wages, diminishing consumer confidence, and growing inflation. Now, suddenly, Ueda is hinting at an interest rate hike. It's like trying to use a little bucket to bail out a shipwreck. The boat's sinking. And instead of plugging the gaping hole, we see the Bank of Japan applying tiny band-aids on systemic failings. But don't worry. That's just the start. Now, if you think this is just a Japanese problem, we've got news for you. The US, Europe, even the sleepy bond markets of developing economies are all on edge. Only hours after the JGB yield spiked, US Treasury yields followed suit. The 10-year Treasury yield, the staple barometer of investor confidence, jumped a palpable 4 basis points to 4.21%. Why should you care? Well, folks, as trouble in one bond market spreads globally, it's like dominoes. The US, already pummeled by high domestic interest rates following Jerome Powell's hawkish federal monetary policies, saw pressure on its bond markets immediately. Investors getting nervous now? They should be. It doesn't take an economist to see the writing on the wall, alarm bells. Remember, the US election is already touted as a major stress point for the global economy, and now Japan's yield shuffling adds uncertainty to an already delicate international financial tightrope. Too much volatility in bond yields typically signals instability and a potential loss in market confidence, never a great sign. Let's do some quick math here. 1. When bond yields rise, borrowing costs rise. 2. When borrowing costs rise, it becomes more expensive for governments, businesses, and people to service their debt. 3. Japan's national debt is insane, sitting at over 250% of GDP. Yes, I said 250%, not 25%. Do you know what that implies? For every $1 of income Japan produces, it owes $2.50. Astounding. How will Japan service its debt with bond yield spiking? This interest rate hike means an instantaneous ballooning of Japan's debt payments. So, coming out of this mess, the primary issue isn't just inflation control, it's about staving off a gargantuan debt crisis of unmanageable proportions, nationwide and soon, globally. And, folks, it's not just Japan walking this tightrope, oh no. Rising US Treasury yields means the American debt servicing costs are also getting steeper. A government that's already battling a $33 trillion national debt will only see further strain. Similar to Japan, if long-term Treasury yields continue climbing, the US budget deficit could explode at hyperspeed. You smell trouble yet? In his Nikkei chat, Ueda couldn't wait to stress about pushing inflation to 2%, as if that is Japan's golden ticket. But guys, Japan's inflation problem. Oh boy. Here comes the punchline. Japan's actual inflation, factoring in energy costs, has either sputtered over, or outright dwarfed that 2% target, now sitting comfortably above 3% most months in 2024. So, what's Ueda doing? It's like trying to hit a dart on a dartboard that's stuck in someone else's house. They missed their target ages ago, and it seems Ueda's strategy regarding inflation is akin to playing a losing poker hand and bluffing all the way through. Now, go ahead and mix this with the juicy decline of the yen, now as weak as 150.64 per dollar, and you've got an economy stuck in reverse. A weaker yen boosts inflation through rising import costs, but Japan's exports stand to benefit. Wrong. Japan is no longer your old-school industrial powerhouse. Tokyo relies heavily on other factors for growth stimulation, and a freakishly fluctuating yen doesn't help. Picture this, Japan knows that without intervention the yen could be caught in freefall. That's why, I guarantee it, you'll see BOJ officials watching the currency like hawks and stepping in with countermeasures before it crashes through even softer bottoms. But any intervention will likely come too late, and cost far too much. Alright, let me give you a breakdown that's nice and easy to digest. 1. Bond market volatility equals unstable investment environment equals rising cost of national debt servicing. 2. Weak yen equals rising import costs equals pain on Japan's consumers and businesses equals lower disposable incomes and economic contraction. 3. Insipid inflation management equals price volatility equals always managing from behind instead of leading forward. This, my friends, is how fires start. What makes this even more chaotic? Japan doesn't operate in isolation, and the bond markets are heavily interconnected. If Japan messes this scenario up for itself, which it looks like it's plotting to do, it could set off a financial contagion. Remember the 1997 Asian financial crisis? Well, although not the same size or scope, these types of bond market hiccups in Japan have rippled through global economies before. What about Europe? Negative interest rates, which Japan maintained for way too long, spooked the European Central Bank as they teeter on avoiding dips into outright recession. Watch the European bond yields if you want more fireworks ahead. And let's not forget, emerging markets heavily reliant on exporting to Japan could be in for a shock, as Japan's wobbly economy weakens their demand for imports, adding to the broader slowdown already witnessed in global trading patterns post-pandemic. This is a house of cards, my friends. Each domino toppling in Tokyo sends quakes to New York, London, Frankfurt, Hong Kong, and all the developing markets in between. Ladies and gentlemen, as always, the takeaway here is that Japan's recent and eventual rate hikes aren't an isolated economics problem. You're looking at a reactionary event in an economic system already on the ropes. The Bank of Japan will, in my very humble yet frustration-soaked opinion, fail in properly managing the dual threats of ballooning domestic debt and volatile inflation pressures. Ueda's actions scream textbook examples of coming too late to the game of damage control, erasing confidence in Japan's ability to wield proper monetary policy. And with the global bond markets so tightly tied to one another, if Tokyo slips further down this sketchy slope, well, the global bond market might just start breaking apart at the seams. So prepare yourselves, folks. We're in for quite the wild ride. Thanks for watching, as always, and if you're still optimistic for 2024's global economy, you might want to check your portfolio twice. Until next time, stay sharp, be critical, and remember, trust your instincts over policymakers any day.